If you've ever looked at a company's financial report and felt completely lost, you are not alone. Balance sheets look like walls of numbers, but here is the truth. Once you understand just 3 sections and 4 key ratios, you can read any company's financial health in under 10 minutes by the end of this video. That is exactly what you'll be able to do. Think of a balance sheet as a company's financial photograph, not a video, a photograph. It captures one single moment in time, everything the company owns, everything it owes, and what is left over for the owners. It has 3 sections: assets, liabilities, and equity. And there is one rule that never ever breaks. Assets always equal liabilities plus equity. Always. If they don't, something is wrong. We'll come back to that equation, but first, let's walk through each section. Section 1. Assets. These are everything the company owns or is owed. Assets are split into 2 categories: current assets and non-current assets. Current assets are things that can be converted into cash within 1 year. Cash itself, money customers owe the company, that is, accounts receivable, inventory, and short-term investments. Non-current assets are long-term, things like property, equipment, patents, brand value, and something called goodwill, which is the premium paid when a company acquires another. More assets generally means more resources, but what really matters is the quality of those assets. A warehouse full of inventory that can't be sold is an asset on paper, but a problem in reality. Section 2. Liabilities. These are everything the company owes to others, again split into 2 categories. Current liabilities are due within 1 year, things like accounts payable, short-term loans, and accrued expenses. Long-term liabilities are due after 1 year, things like bonds, pension obligations, and long-term lease commitments. Now here is an important nuance. Not all debt is bad. A company might take on debt to fund expansion, buy equipment, or acquire a competitor. The key question is whether the debt is manageable relative to assets and earnings. Too much debt compared to assets. That is a warning sign. We'll measure that in a moment. Section 3. Shareholders' equity. This is what is left for the owners after all debts are paid. The formula is simple. Equity equals assets minus liabilities. The equity section typically includes common stock, retained earnings, additional paid-in capital, and treasury stock, which are shares the company has bought back, shown as a negative number. The most important number here is retained earnings. This is the accumulated profit the company has kept in the business over its lifetime rather than paying out as dividends. A company with growing retained earnings year over year is consistently profitable. That is a very good sign. Let me show you the golden equation visually. Imagine a company with $500,000 in total assets. That full bar represents everything they own. Now that same $500,000 must be funded somehow. In our example, $300,000 of it came from liabilities, money borrowed from banks, suppliers, or bondholders. And $200,000 came from equity, money invested by shareholders plus profits kept in the business. Both bars are exactly the same width. That is the balance sheet balancing. Every single company, from a corner shop to Apple, follows this exact equation. If it ever doesn't balance, either someone made an accounting error or something more sinister is happening. Now let's talk about the 4 numbers every investor checks first when they open a balance sheet. Number 1, the current ratio. That is current assets divided by current liabilities. A ratio above 1.5 generally signals the company can comfortably meet its short-term obligations. Below 1.0 is a potential cash flow warning. Number 2, the debt-to-equity ratio. Total liabilities divided by shareholders' equity. Lower is generally safer. A very high ratio means the company is heavily leveraged, which amplifies both gains and losses. Number 3, retained earnings. Is this number growing year over year? If yes, the company is consistently profitable and reinvesting in itself. Number 4, book value, per share. Total equity divided by shares outstanding. Compare this to the share's market price. If a stock is trading below its book value, it may be undervalued, though always dig deeper before assuming that. Let's wrap up with the 4 things to remember. 1, it always balances. Assets equal liabilities plus equity. No exceptions. 2, focus on trends, not snapshots. 1 balance sheet is a photo. 3 years of balance sheets tells you the story of whether the business is getting stronger or weaker. 3, growing equity is a great sign. Rising retained earnings over time means the company is compounding its own value, just like compound interest from last Monday's video. And 4, check the ratios. Current ratio tells you about short-term health debt. To equity tells you about risk. Together, they give you a fast, clear read on any company's financial position. Now you know exactly what to look for. Here is your homework. Pull up any company's annual report, Apple, Tesla, a local business you are curious about. Search for their balance sheet and spend 5 minutes on it. Check the current ratio. Look at retained earnings. See if equity is growing year over year. You'll be amazed how much you can learn in just a few minutes. If this video helped you, please hit like and subscribe. New finance videos every Monday, Wednesday, and Friday. On Friday, we're tackling what the Federal Reserve's interest rate decisions actually mean for your money, and why every investor needs to understand this.